Dear attendees, welcome to this webinar. My name is Kim Dupont. I'm working at the Grenoble Chamber of Commerce and Industry in France. And we participate to the European project SESAM. This project from the European Commission helps companies understand and win public tenders in France, in Europe, and abroad. This webinar is about financial guarantees for public tenders, and the speaker is Emilie Rhône-Alpes from the Banque Populaire Auvergne Rhône-Alpes.
Hello everyone. So today I'm going to introduce you to the International Bank Guarantee System. So I've worked, a little word about myself first. I've worked in Banque Populaire Auvergne Rhône-Alpes in the back office who deals with guarantees for the last 3 years. And that's why I'm here to explain to you the main features of bank guarantees, as well as 2 or 3 tips to help you in case you have to apply for one. First of all, the definition. As you may know, an international bank guarantee is very often required in an international business contract. So through this guarantee, the issuing bank undertakes to pay an agreed amount to the beneficiary in case the co-contractor did not respect its obligation. This protects the import company against the obligation not respected from the export company, and it protects the export company in case the payment is not made. Why are bank guarantees so widely used? It's because they are independent from the contract, so they can be, any demand can be made without reference to the commercial contract. It's a simple letter addressed to the bank stipulating that you want to request a payment under that guarantee. So it's very easily made and it's independent. Those are really the 2 main aspects that make bank guarantees so widely used. So there are 2 types of guarantees. A direct guarantee. It's usually made on some countries, and it also depends on the type of bank you have. If it's a very big bank that is widely known in the world, then you may be able to make a direct guarantee. An indirect guarantee is very often required in some countries like Middle East. And basically how it works is that you'll apply for a guarantee to your bank, who will then request a local bank to issue the guarantee on its behalf. So how is a guarantee payment demand made? It's when the co-contractor does not fulfill its obligations. The beneficiary of the guarantee requests the payment of the guaranteed amount to the bank who has issued the guarantee. So in case of indirect guarantee, the demand will be made to the local bank. And in case of direct guarantee, it will be made to the export company's bank. So here you have some examples of countries that deals with direct guarantees or will accept direct guarantees, and some countries who will definitely need indirect guarantees. By that, I mean that those countries will request the guarantee to be issued in their own country by a bank in their own country. So usually direct guarantees are made in Western Europe. You've got a contract between France and Germany. Very often then German companies will accept guarantees issued by French companies and vice versa. For indirect guarantees, the main countries are, or like local regions, are Middle East, Maghreb, Africa, whether they are French or English-speaking countries, Asia, Russia, and so on. So for international business contracts, there are different steps. And usually you'll find that each guarantee corresponds to one of these steps. So the first step will be the bidding, and where you will be requested to issue a bid or tender guarantee. This then there's the awarding process, and when you've been awarded the contract, you'll be requested to issue a performance guarantee, and you may be, if there's an advance payment made, you may be requested to make an advance payment guarantee as well. And the performance guarantee and the advance payment will last throughout the execution for the performance and until usually the material is delivered or a partial part of the contract is done for the advance payment. And at the end, when the final acceptance has been made and you enter the warranty step, then you'll usually be asked for retention warranty. By that, I mean that usually there's an amount of money that is retained by the import company. And if you want to access this money, you'll be asked to submit a warranty retention guarantee. On this slide, we've summed up the different aspects of each guarantee. It's like a kind of memo. So first of all, if we look at the bidding guarantee, you may see that the ordering customer is the one to ship the goods or to deliver the obligations. The aim of the bidding guarantee is for this company to be able to bid for an international contract. The amount of the guarantee usually corresponds to 1 to 5% of the bidding amount. It is usually valid until the performance guarantee is issued, if you've been awarded a contract, or the release of the bidding guarantee if you haven't been awarded the contract. The payment request cases. So for bidding guarantee, usually it's if you cancel your bid, if you refuse to sign the contract but you've been awarded the contract, or if you do not provide the performance guarantee in time. If we move to the advance payment guarantee details, you'll see that the ordering customer is here again the shipper or the export company. The aim of it is to guarantee the beneficiary the reimbursement of the down payment that has been made. The amount, it corresponds to the down payment amount. And usually it's between 10 to 30% of the contract amount. The advance payment guarantee is valid usually until the goods are shipped or until the provisional acceptance has been made. The payment request, it's usually when the shipper cannot release the goods, has not been able to provide the goods on time or not provide its obligation on time. So if we now move to the performance guarantee, here again, the ordering customer is the export company. The aim is to guarantee the beneficiary the fulfillment of the shipper obligations. The amount is between 10 to 15% of the contract, and it will be valid until the final acceptance has been made. We did not detail the payment request cases, as there are numerous and various reasons. whether the goods are malfunctioning, the shipment is delayed, the studies has not been made on time, or do not correspond to the contract details. Here, there are very different cases to make a payment request. Finally, the warranty retention guarantee. Here again, the ordering customer, it's the export company. The aim is to allow the payment to the export company of the warranty retained amount. It's what I've been talking about you earlier on. It's this amount of money that the import company keeps in case during the warranty period, in case they have to make repairs or anything that has not fully come to satisfaction. The amount is usually between 5 to 10% of contract amount, and sometimes it can also be of 3%. This really depends on the contract. The validity, usually it's 1 to 2 years after the final acceptance certificate. And here the payment request is if the goods are not delivered or if the work has not been done, done as to satisfy the contract obligation. So in brief, the advantages for the export customer is to be able to access the export contracts, especially those with bidding part, because it's reassure the buyer on your ability and capabilities to respect the contractual obligations of the contract. The advantages for an import customer, the fact that you've been able to issue a guarantee, it testified on your ability to fulfill the contract, and it also protect them at each step of the contract in case you do not respect the obligations of the contract. Here we make a little scheme of the process so as to explain how it works. So you see that the commercial contract is made between the export company and the import company, but it's independent from the guarantees. So we've here, it's an example of a performance guarantee in a case of indirect guarantee. So the export company will ask its bank to request to issue a guarantee. The export company's bank will then request the issuing bank, usually its correspondent bank in the country of the import company, to issue the guarantee in its behalf. The issuing bank will then issue the guarantee in favor of the import company. Then, as you may, if the export company does not fulfill its contractual obligation, the import company will then request the payment of the guarantee to the issuing bank, who will in turn pay back the import company the guaranteed amount. The issuing bank will then request the export company's bank for the reimbursement, and the export company's bank will then turn to its customer for the reimbursement of the guaranteed amount. So here it's the different steps. It describes what the previous slide. So the issuing request, the ordering customer requests the issuing of the guarantee to its bank. Either it's a direct guarantee, then the export company's bank will issue directly the guarantee in favor of the beneficiary. We haven't not illustrated this in the previous slide, but it was important for us to put here in written so as to remind you that this can be done. And so the indirect guarantee corresponds to the previous slide, and that's the export company's bank requests its correspondent bank in the beneficiary's country to issue the guarantee in favor of the beneficiary. Then the issuing parts, the local bank issue the guarantee in favor of the beneficiary. Then there's the payment request. So the beneficiary asks the local bank to reimburse the amount, guaranteed amount, because the export company has not fulfilled its obligation. And this bank will then turn to the export bank's company, who will then in turn ask its client to reimburse her. So we'll now turn a little bit to each of the 4 guarantees. So we'll start by the tender guarantee, which is also called the bid bond. Here, to sum up of the context, it's when you bid for a contract, the aim is to guarantee the reliability of the bid. It's 1 to 5% of the bid or specified amount, and it comes into force at the bid opening date, and it's valid until the awarding bid date. So here is an example of the tender guarantee. I'm not going to read it fully to you. You'll be able to do that by yourself. I'm just going to point the main part of the guarantee. And here it will be on this tab in the second paragraph. It's the description of when a payment guarantee can be made. This is very specific to tender guarantees. You'll note here that upon present indicating applicant is in breach of its obligation with respect to the underlying relationship because the applicant has withdrawn its bid during the period of bid validity, or having been notified the acceptance of his bid, the beneficiary during the period of bid validity fails or refuses to execute the contract form in conformity with terms and conditions, or fails or refuses to furnish the performance guarantee. This you'll usually find in a tender guarantee because it's very specific as how payment can be made. So if we now move to advance payment or repayment guarantee, so it come into force, it's usually coming into force of the contracts. In the contract, you have asked the import company to make a down payment, and the aim of this guarantee is to reimburse the said down payment that you've received in case the contract is cancelled. So the amount, it will be equal to the advance payment you've received. And here you may note that the amount of the guarantee may be digressive, which means that, for example, if the contracts, you have to ship goods 2 or 3 times, and then you can specify in the guarantee that with its shipment made, the guarantee is digressive. Then it will come into force when the advance payment is received, and this point is very important because if you do not specify when the guarantee come into force, and the coming into force you may be requested to pay the guaranteed amount even if you have not received the advance payment. So this point is very important. And the validity is usually till all the goods have been shipped, or basically when your contractual obligations are met. So here again, you'll find an advance payment example. of guarantee. And here, at the very beginning of the page, you'll see what I've been talking to you about the coming into force. Here it says the advance payment guarantee will come into force upon the crediting of euro and the amount to the applicant's account, and there's the IBAN of your account, maintained with a guarantor, provided such remittance identifies the guarantee to which it relates. So here, this paragraph has, it's mandatory that this paragraph appears in all your advance payment guarantee. Okay, so you'll find on this slide some variability, some variants of text possible, such as the guarantee amount will be reduced pro rate the value of each delivery upon presentation to the guarantor of copies of, and you'll have to list the documents to be presented. Or the advance payment guarantee will remain valid until the date of presentation to the guarantor for copy of the named documents, or until reduced to nil as forementioned, or at the latest until, whichever shall first occur. So this phrase at the end is when the guarantee is reduced depending on some conditions. And so the validity stipulates that the guarantee ends when the amount is reduced to nil. So now we'll move to the performance bond. The contractual contract is when the contract is coming into force. The aim is to secure the fulfillment of the contractual obligations. The amount is 10 to 15% of the contract, and it will come into force very often after the end of the bidding or at the reception of the advance payment. The validity here is the provisional acceptance or the final acceptance. It will depend on the contract. Here again, you'll have an example of a performance bond. Here you may see in the fifth paragraph that we've specified the Incoterm. According to terms and conditions of said purchase contract, the applicants is to renew a performance guarantee for an amount of representing 20% of the above mentioned total amount and covering the applicant's DAP, and then there must be the location, contractual obligation. This is very important because it reduces the cases of request demand, as you've precised the Incoterm relating to the guarantee, to the shipping condition. You cannot be requested to pay if the shipping is made according to those conditions. And here also, partial demand, you may say that we've written partial demand allowed and multiple demands allowed. It's because performance bond may amount to quite a bit of money, and if partial demand are not allowed or multiple demands are not allowed, then for a little thing, instead of requesting only a part of the guarantee, the import company will have to ask for all the guarantee amount. And this is very important because sometimes they may request only a part of the guaranteed amount, and if this is not allowed, they will request the payment of all the amount. And finally, we'll move to the retention money bond, or also called warranty retention bond. So it will come into force at the end of the contract. It will last during the warranty period. And the aim is the bank will undertake to pay a specified amount if any dysfunction remain unsolved after the warranty period. So it's between 5 to 10% of the contract. It can also be between 3 to 5. It comes into force at the beginning of the warranty period. And usually the validity will be 1 year after the final acceptance. So here you have an example as well. But you may see that here again, just like the advance payment guarantee, the coming into force of the retention money bond is depending on the reception on your account of the retention money. I'm going to read the paragraph, which is the retention money guarantee will come into force upon crediting of euro to the applicant's account and the IBAN maintained with the guarantor, provided such remittance identifies the guarantee to which it relates. So this is very important in retention money bond. So I'm going to end this presentation by the essential features in a guarantee, such as, first of all, there are 5 points that must appear on each guarantee. First, the parties. Name explicitly the export company and the import company, which can be referred to the ordering customer and the beneficiary. Precise the type of guarantee, whether it's a performance, bid, advance payment, or warranty retention guarantee. Then the amount, which has to be specifically written down, and the corresponding currency, which is very important because this is the currency that will be used for any request payment. So if the guarantee is in a foreign currency, the risk linked to the change will be on your behalf. Then the dates, the coming into force and the validity dates, and the legal context, which usually it's best if you can have the reference to the URDJG 758, which are the international guarantee text that are widely used among banks throughout the world. And here are a few tips, best practice that can be done, that can be said are: first, be precise. If you have to deliver goods, then use Incoterms as much as possible and always specify the location associated to the Incoterm. This will save a lot of trouble in case there's a disagreement between you and the import companies on that subject. And if the coming into force or the validity are linked to events, always use a document to materialize this event and be precise about it. Who issued the documents, who signs it, what type of document it is, when has it to be made, who is to remit this document to the bank, and so on. As you may see, the fact that to link the coming into force or the validity to a document is more demanding. So usually, as much as possible, use dates instead of events. Favor your bank's model of guarantee as well, if possible, because otherwise, usually the bank will have to take some time to study the foreign text, and usually it may request a couple of or to and fro between you and the import company to agree on the text. If you may use your bank models, usually it's faster. And please anticipate. Don't wait until the bidding date to submit the financial part to your bank, because they will have to work on the contract to adapt their documents to the contract. And it may request a couple of days to issue the guarantee, especially if it has to be done through a local bank in the country of the contract. So please anticipate. I hope everything has been clear. Thank you for your attention. And here you'll find my direct contacts. So Emilie REINHART, I work at Banque Populaire Auvergne Rhône-Alpes. Feel free to contact me if you have any question about this presentation. And you may see as well that there are Kim Dupont's contact as well.
Thank you very much for your listening.